Good morning and happy Friday. This is Millennial Market Talk, and I'm Mark Jones, your Millennial Mortgage expert. And this is your daily Millennial Mortgage update. So let's jump right into the daily interest rate. I don't want to waste any time. All right, as always, I have to disclose that these are a collaboration of interest rates throughout the United States as an average, and it's pretty darn accurate. And again, these are rates from the previous day because there's no way to do that in real time. And being so accurate. We're going to do a price tag of $300,000, 20% down at a 700 credit score, and that ranges to 700 to 720. And we are looking at a 30-year at 4.125. Now, as mentioned yesterday, guys, if you put less down right now in this market, your interest rate actually drops. So I'm excited to get into this article today. Today's article is brought to us by Dave Ramsey. I can't say that I'm a huge fan, but I'm also not I don't downplay him. It's just we have different approaches and different views on things, but let's dive right in. The article is entitled Top 15 Mortgage Questions Answered. This should be a good one. I'm not going to go through the entire article just yet because today is Friday with a Friend, and I'm excited to share this with you guys. So number one, how do you qualify for a loan? I mean, that's a loaded question, right? We're going to get into that. Number two, can you get a mortgage without a credit score? That's a good question. I'm looking forward to seeing what he has to say about it. Number three, what is the difference between being pre-qualified and pre-approved? Number four, how much home can you afford? Number five, how much should you save for your down payment? Number six, how do you know which home mortgage option is right for you? There's 15 of these things, and I think what I'm going to do is actually chop this into 2 episodes. So on Monday, we will be doing the remainder of these for you guys. That being said, Friday with a Friend, introducing Jody Trevino.
Good morning. Good to be back.
Awesome. I love having you on this show, man. The energy is always fantastic and always so early and chipper.
Funny about this article, similar to last week, not a mortgage expert writing it. So just remember that as we...
That is a great point on this. Let's dive right into this. I want to keep it as short and sweet as possible, but at the same time, I mean, there's maybe a lot to be said. Yeah. I'm not necessarily a Dave Ramsey fan or advocate. I think things needed to be done differently given somebody's situation. But let's dive into this. So number one, how do you qualify for a loan? It says the idea of meeting with a lender can be intimidating, especially if you're buying the first home. After all, it is possibly the biggest purchase you'll ever make. Take a deep breath and relax. You don't have to be stressed. Think of the first meeting with your lender as a get-to-know-you session. They'll simply want to learn a few basics about you and your financial situation. Then it comes to the paperwork. Once your loan process gets started, be prepared to provide proof of where you work, your income, any debt you have, your assets, how much you plan to put down on your home. A good lender will clearly explain the mortgage options and answer all questions so you feel confident in your decision. If they don't, find a new lender. I have to agree with that right there. Yes, a mortgage is a huge financial commitment, and you should never sign up for something you don't understand. It's likely that your lender will approve you for more money than you want to spend, but keep in mind, just because you qualify for a big loan doesn't mean you can afford it. So, number one, what do you think about that?
Yeah, I think that one's good.
I have to agree. It's like dead on the money. Let's see. Number two, can you get a mortgage without a credit score? You want to take this one?
Yeah. So number two, can you get a mortgage without a credit score? So it says this is one of the most commonly asked mortgage questions, and the answer may surprise you. If you've paid off all your debt, and we recommend you do before buying a home, it is possible you won't have a credit score when you meet with a lender. That might make you nervous, but don't worry, you can still get a mortgage. If you apply for a mortgage without a credit score, you'll need to go through a process called manual underwriting. Manual underwriting simply means you'll be asked to provide additional paperwork for the underwriter to review personally. Your loan process may take a little longer, but buying a home without the strain of extra debt is worth it. Not every lender offers manual underwriting. Do a little research on the front end to find the ones in your area that will.
All right, so I've got a couple of bones I want to pick with this article.
Yeah.
You want to start?
Yeah, I think the first red flag for me is that we recommend you pay off all your debt.
No one would own a home.
And not everyone has the means to do that.
I agree. Yeah, that's kind of how this Dave Ramsey philosophy and I kind of butt heads. But let's carry forward. The other thing that most lenders don't know is these types of loans for no credit score are either going to be private money, so they make their own decisions with a bank, things of that nature.
Right.
But there is also a product that we offer here, which is a conventional loan. As long as you put 10% down, they use other forms of verification for your payments, your payment history, such as a phone bill, light bill, apartment, things of that nature. So already I found two things in here about what he's saying. Let's move forward. There's some more things that we want to talk about here. Number 3.
Not a good one for you there.
Oh, go ahead. Yeah.
I would just add that this isn't the best thing for the borrower either, because as we all know as lenders, manual underwriting is much stricter, much more stringent than our automated underwriting system. So if someone's parted with the cash from paying off the debt, they don't have cash, now they don't have a score, and now they're under strict guidelines.
Absolutely. Now, didn't this thing mention that you should be paying off all of your debt?
Yeah, and they
so
recommend
wouldn't
it.
your ratios, if that you took that philosophy, wouldn't your ratios be just your mortgage?
That would be it, yeah.
I mean, then you don't have anything else to verify what you're paying on time. It's kind of like an oxymoron or a counterintuitive.
Yeah. That one's funny.
Okay, number 3. What's the difference between being pre-qualified and pre-approved? A quick conversation with your lender about your income, assets, down payment is all it takes to get pre-qualified. But if you want to get pre-approved, your lender will need to verify your financial information and submit your loan for preliminary underwriting. A pre-approval takes a little more time in documentation, but it also carries a lot more weight. Obviously, which is better, and we can go into that. I would imagine that no one else would disagree with this. Pre-approval loan officers, we cannot pre-approve a loan. We cannot approve a loan. We can only deny a loan. And if you're out there with lenders that are doing pre-qualifications, at least verify that they've obtained all the documents, they've met with the borrower, they've verified the down payment if there is one available.
Right.
So I have to agree with that. Do you have any thoughts?
Yeah, I think your documentation carries all the weight.
Absolutely. Okay, so let's move on to number 4. How much can you afford? You want to grab this one?
Yeah, so it says buying too much house can quickly turn your home into a liability instead of an asset. That's why it's important to know what you can afford before you ever start looking at homes with your real estate agent. We recommend keeping your monthly mortgage payment to 25% or less of your monthly take-home pay. For example, if you bring home $5,000 a month, your monthly mortgage payment should be no more than $1,250. You'll find that means you can afford a $211,000 home on a 15-year fixed rate loan with 20% debt.
Oh my goodness. Okay, so
I
don't think you need to finish that either. I mean, you want to start?
I'll let you start this one.
Okay, so here's the concept. If you are taking, we as lenders actually calculate your debt to income ratio based on your gross. So that is prior to taxes being taken out. We typically go about to a 46 or so back-end ratio. Certain loan products will allow you to go even further, up to 56% or so, especially your VA products. Now, the fact that he's suggesting 25% of your take-home, so now take away, let's say, 20% of your income monthly, 25% of that, then he wants you to put it on a 15-year mortgage. In our market today, what can you buy?
Absolutely nothing.
I mean, even let's say the average median income was $40,000, $50,000. You could buy, based on these figures, and I'm just going to guess, you guys can check me on this, but I would say maybe a $215,000 house based on what he's talking about. That doesn't exist right now.
Yeah.
Especially on a 15-year mortgage.
Exactly.
So
yeah, he used $211,000 as an example. In San Antonio, our average is $90,000 more than that.
Absolutely. So that one right there, and this article was just recently written, so I'm surprised that came through. So let's move on. Number 5, how much should you save for your down payment? Here we go. We recommend you put at least 10% down on a home, but 20% is even better because you won't have to pay private mortgage insurance, other known as PMI. PMI is an extra cost added to your monthly payment that doesn't go towards paying off your mortgage. Saving for down payment takes hard work and patience, but it's worth it. Here's why. So,
yeah,
what are your thoughts?
I think this is where the way you and I think departs big time from the Dave Ramsey philosophy, which is basically use your cash and don't leverage the bank. I don't agree with this at all. I don't think it makes sense for anyone to part with a large amount of cash. And then when he says, it takes patience, but it's worth it. Well, the 3 years you spent saving that 20%, you could have bought a home already.
Well, I mean, you're 20%. Let's use his scenario right there.
Yeah.
What was he using? $211,000. What 20% of that? You're talking $42,000.
Yeah.
You can't save that in 3 years if you're on a $50,000 budget or annual income.
And you could have bought a home 3 years ago with
and
a
it
low down
appreciated.
payment, and it appreciated.
And
have equity.
You missed out on that asset source. Man. And this is, I think, what I don't know. I can't say that it's wrong or bad. It's just a different way of thinking.
Yeah.
Essentially, you're missing out on the opportunity to gain equity that we've seen over the last several years. I mean, if you are purchasing in Texas, this is what I consider bass backwards advice. And the reason for that is you would have missed out on the opportunity, and that's what people use as opportunity cost of not having those funds in the bank, even if you did have the funds to put down. Secondly, mortgage insurance, you can put less than 20% down and get rid of your mortgage insurance. Get with us at lockandterraloans.com to find out your options, and we definitely have options like that. So let's do number 6 as the last one, and then we will pick this back up on Monday. Number 6, how do you know which mortgage option is right for you? With so many mortgage options out there, it can be hard to know how each would impact you in the long run. Here are the most common mortgage loan types. And before I go any further, I'm going to point out the fact that he said impact on you in the long term. Right. The average homeowner stays in their home anywhere from 5 to 6 years. Recently, it went up to 8, simply because of the pandemic and housing prices and the way that they've soared. And you wouldn't have an issue staying in there longer if you just gained $100,000 in equity. Yeah. Right?
25% in San Antonio from last year.
Come on.
It's insane.
So that's one thing that I think in perception, he's thinking that everybody's buying their forever home, not necessarily their first home or their second home, or their move-up home. So let me continue. So adjustable rate mortgages, Federal Housing Administration, which is FHA, Department of Veterans Affairs, VA, or fixed rate conventional loan. He's going to go over the pros and cons of each one. And I believe without knowing you, without seeing any of your financial information, he's going to say, we recommend choosing a 15-year rate conventional loan. Why not a 30? Because you'll pay thousands of interest over the next 30 years. And I think that's where he goes wrong on this. Any thoughts?
No one's going to be there 30 years. Come on, man.
I think those times are over.
Yeah,
I can't say that they're completely over. And who knows, with housing market the way that it is and has been in the last 3 years, which in my opinion can only continue for so long. They're slowing it down with interest rates rising. Right. So as interest rates rise, the temperature here in San Antonio drops. So I'm hoping you guys out there can make your own decisions. Obviously, you've heard us read some of the touch points from this article, but by all means, make up your own pros and cons. But I think the most important thing is to get with a lender that can give you and provide you with the options, the good, the bad, and the ugly. A lender that will provide options for you and not just cookie cutter to where you come in and you're a certain credit score, they automatically put you within a certain program. Right. There's plenty of bonds available. There's so many things that he missed within this article that I don't know, man. This is out there, and there's thousands of people that are reading this and believing it.
Yeah, that's the worst part. My closing comments on this whole thing, it would be to your point. If you have a good loan officer that is on your side, they're going to protect you. They're going to look at your whole financial picture, and they're going to make sure you're good where you're at. Because we don't want you to not be able to pay your mortgage.
100%. And I think that I'll end with this. The concept of waiting until you have the 20% has already been proven wrong, in my opinion, over the last, let's say, 10 years, 11 years since the last mortgage crisis. In the sense that mortgage lenders, they've made it tougher for us to get customers approved. Right. They've put in guidelines that are essentially protecting the world's economy, because as we know, mortgage-backed securities, that's a big part in our economy. Right. And as we went through this pandemic, we are now within a 2-year span back to the same mortgage default rate as we were prior to the pandemic, which was already historically low.
Right.
Okay.
Yeah, that's the big one.
I agree.
Rates are low. They're rising. They're still
historically low. Absolutely. So if you guys are in Texas, planning to move to Texas, give us a holler. Visit us at LaCanteraLoans.com. And one of our trusted loan officers will be able to provide you with your options. We'll jump on a Zoom call with you. We will give you the attention and advice that you deserve. So that being said, this was Friday with a Friend.
Yes, it was.
I am Mark Jones, your Millennial Mortgage expert. We'll catch you on Monday. Have a great weekend. Stay safe.